Okay, so we're going to switch gears a little bit here, and we're going to go into basically the backbone of accounting, known as the accounting equation. The fundamental rule behind accounting is that anything that is used by a business to generate income has to be funded by equity or liability. In a basic practical sense, we can think of this as putting in our own cash into a startup company or taking out a bank loan to get a business going. So this here is the equation I'm talking about. Assets equal liability plus owner's equity. This formula is what makes up the balance sheet. So if you have a look at the balance sheet, as we will later, we will have one section which adds up the total assets, and we'll have a section generally beneath it which will add up liabilities and owner's equity, and you will find that those two sums are equal. Total assets equals total liability plus owner's equity. So as the formula suggests, the total value of assets owned by a business must equal the value of the liability and owner's equity. Liabilities are often referred to as debt, and owner's equity can be shortened to just equity. So an asset is any economic resource which is controlled by an entity that is expected to provide current or future benefit to the business. So the most straightforward example is cash. Businesses, as a general rule, need cash to function, but they can be a whole array of other things that help you. Office supplies help you run a business. Merchandise inventory can help you. Land can help you. Machinery and equipment can help you. To take this idea a step further, it can even be things which you cannot really see, like accounts receivable. When someone owes you money and you expect to collect it from them in the future, that is a future benefit to the company. And we'll talk more about all of these things as we proceed with the course. Moving on to liabilities and debt. So anything that's payable to an outside party, and outside parties can mean creditors, suppliers, employees, and governments. Some examples of debt which the company may owe to the aforementioned parties are accounts payable. These are usually amounts owed to suppliers. Notes payable might be something that you owe to the bank. Salaries payable are generally amounts owed to employees, and taxes payable, of course, are owed to government. Moving on to the last element of our accounting equation, the owner's equity, or simply equity, is the amount of an entity's assets which remain after liabilities are subtracted. And the equity can also be called net assets. So a good way to think about equity is some of you might be proud homeowners, and you think about how much your home is worth in the open market, and you think about how much you owe to the bank or some lender. The difference between those two amounts is your home equity. And you might have heard some commercials or been talked about this idea by a banker about how you can use your home equity to do other things. Well, that's what they're referring to. So rearranging the accounting equation a little bit, if you were to take that idea of what equity is, this is kind of what it looked like. Asset minus liability equals equity. So let's try a quick question here. If a business has $100,000 worth of assets and bank debt of $30,000, how much equity does it have? I'm going to scroll up a little bit again. So we're just following that formula up there, and we're going to go ahead and try this together. So we'll go ahead and plug our assets in. We have $100,000 worth of assets. And then we're going to say minus our liabilities, which is bank debt of $30,000. And that's going to give us a nice round number for our equity of $70,000. So to finish up on equity here, to understand equity at a fundamental level, we should first define two basic terms. First, owner investment. When an owner adds funds or other assets into the business, this results in an increase in equity. And owner withdrawal. When an owner or investor takes funds or other assets out of the business, this results in a decrease in equity. So, put it in simple terms, when you have your own business and you put money in, that makes your equity go up. If you take money out of your business, that makes your equity go down. So, with that in mind, let's pause here and take a minute to try the next few questions, and we will resume in the following video.